All right, so welcome back to the channel. Today we are on Seeking Alpha and they are comparing DGRO and VIG. They are saying which is the better buy. So when it comes down to it, DGRO and VIG are similar ETFs. They have low expense ratios. They have a ton of money within the asset and they're focused on dividend growth. But Seeking Alpha says that DGRO has outperformed VIG in total returns and yield on cost since inception. They believe that DGRO is better for the long term. So let's take a look at it. Let's break it down and let's see if this could be potentially added to our portfolio. So right off the bat, DGRO and VIG, let's compare some things here. Expense ratio on DGRO is an annual fee of 0.08%, while VIG charges 0.06%. So if you just base it off of that, VIG is your winner. But let's break it down further. So now they're saying a $10,000 investment into VIG, you can expect every $10,000 you pay $77 in fees. Whereas DGRO, you're going to pay $103 in fees every $10,000 invested. So what is the real difference here? So Seeking Alpha does a great job here, and then we'll look at it on Fidelity to see the actual composition. But VIG is a larger ETF, and it basically starts with all dividend-paying companies. It screens for stocks that have been paying growing dividends for 10 years or more consecutively. So to make it into VIG, these companies have to raise their quarterly dividends for 10 years or more. Now look, on here you can see VIG stocks with greater than 10 years of consecutive dividend raises, plus the bottom 75% in terms of yield and market cap weighted. What it's excluding is the top 25% of dividend yields in an effort to avoid stocks that may no longer have room to increase their dividend payments over time. So this is the holdings of VIG, and let's break it down. So as you can see, you have the circle here to show it. Technology represents 23.5%, whereas financials 18%, healthcare is 15%, and feel free to take a snapshot of this just for your holdings. So now, Microsoft, Apple, and United Health Group make up a large percentage of VIG. Microsoft is 5.53%, Apple's 4.5%, United Health Group is 3.5%. So when you buy ETFs like this, you got to make sure if you're holding individual stocks such as like Microsoft, Apple, United Health, maybe this is not the best fund for you because you already have a greater concentration in these individual stocks. You always need to keep that in mind when you're going to buy these as a long-term hold. Next, we have DGRO. What makes stocks eligible to go into DGRO? The eligibility is REITs are excluded. There must be at least 5 years of consecutive dividend growth. PFIC is excluded. And all the remaining stocks are weighted in proportion to the value of their dividend payments. So definitely different than VIG. Now let's break down the holdings. So I want everybody to see this DGRO. Remember, stocks with greater than 5 years of consecutive dividend raises. They must have positive consensus earnings expectations and under 75% payout ratio. And remember, the total dividend payout is weighted. So now let's take a look at the holdings breakdown. As you can see here, financials is a little different than VIG, is 18%. Technology is 18%. Remember, VIG was 23% technology, while financials was only 18%. So there's more equal weighted here between financials, technology, and healthcare, which is a nice balance compared to VIG. Let's look at the top 10 holdings. JP Morgan is 2.94%. Microsoft is still in there, but a lesser percentage at 2.92%. ExxonMobil, Broadcom, Apple, and Johnson & Johnson. As you can see, there's a different composition here, but we'll break it down further on Fidelity to get an in-depth look. So I brought up the composition. The top here is DGRO, and the right side is VIG. Let's focus on DGRO. Holdings, 424 holdings. Top 10 of these companies right here make up 27% almost. And as you can see, Microsoft is a little lower at 3%. JP Morgan, 3%. And remember, annually, they're going to adjust these holdings. Broadcom, ExxonMobil, AbbVie, Johnson & Johnson, whereas VIG is only 318 companies. The top 10 of these companies make up 31.76%, so almost 32%, whereas they're more heavily relying on Microsoft at 5.3%, Apple at 4.4%, JP Morgan at 3.25%, and the list goes on. So when comparing PE ratios of VIG and DGRO, these are the top 10 holdings. I think it's important to see this. VIG has a slightly higher PE ratio at 25, whereas DGRO has an average of 23 PE ratio. So this is why Seeking Alpha likes DGRO more, because there are more companies that make up a lower PE ratio that they believe are going to be good for the long term, such as JPN has a PE ratio of 10, Johnson & Johnson 12, Chevron 11, versus when you look at VIG, the majority of these are above, 25 to 35 on their PE. So they think they can get more value with the DGRO. But I think it's interesting to look at the PE values of the top 10 companies making up these ETFs. So I wanted you to see firsthand the dividends, DGRO on the left, VIG on the right. As you can see, DGRO has a dividend yield of 2.41% versus VIG has a dividend of 1.86%. Expense ratio, as we said before, 0.08% for DGRO, and VIG has a 0.06 expense ratio. So now let's just look at the life of the performance of each one. DGRO, the life performance is 10.96%, which is slightly higher than VIG, which is 9.37%. And as you can see, look at the 5-year. DGRO actually lagged VIG when it comes to gains at 12.89% versus a 13.84%. So there are differences based on which part of the market is doing better. But overall, DGRO, although it has a slightly higher expense ratio, is performing better. So using the Fidelity screener, we can compare DGRO to VIG. So I just want you to see it side by side. Looking at DGRO, it's an iShares Core Dividend Growth ETF, whereas VIG is a Vanguard Dividend Appreciate Index Fund ETF. They're both issue type as ETF. This is the price of DGRO, $55 versus VIG is $175. And I wouldn't let that discourage you if it costs $175 a share. You're still getting the same gain whether the percentage goes up 5% on each. Just depends on how much you can invest in them. You can see the volume now. I'm going to keep this down so you can see the volume, 1.4 million traded a day versus 800,000 in a day for VIG. And total market so far, they're up very similar, 1.26% versus 1.23%. But look at the market total return in 1 year. You can see VIG is leading the way. And why is that? Because it's heavier involved in Microsoft and Apple, and technology is ruling right now when it comes to 2024. And you can see the expense ratios there. I wanted you guys to get a comprehensive review here. So to DGRO, you can see the sector exposure. Let's just compare them. DGRO to VIG. Financials and DGRO are 18% versus VIG is 23%. So there is a difference already of how they're weighted. And remember, like we said before in the beginning of the video, DGRO is more evenly distributed. You have 18% and 17% between financials, technology, and healthcare. I like that. It's nice not to be so one-sided when it comes to like sector exposure. Versus VIG is 23.47% technology. So you really got to see what else do you have in your holdings, whether it's individual stocks that are technology-based, and make sure you're not doing too high of a percentage. Let's look at industry exposure. Industry exposure, as you can see, DGRO, pretty even across the board. You got banks at 7.5%, oil at 7%, pharmaceutical 6%. So they're all evenly weighted under 7%. VIG, software, because technology and the semiconductors, averaging 7 and 8%. So definitely interesting there. Pharmaceuticals 5%, healthcare providers and services 5%. So there definitely is a difference between the holdings. All right, so Fidelity has a great feature where you can compare other ETFs against each other. So I typed in VIG and I typed in DGRO. VIG is the candlesticks that you see here in green and red, and DGRO is the blue line. So we can see how it's performed. So I put on the 6-month chart to see, and as you can see, DGRO is actually trailing VIG a little bit, where DGRO is up 4.7% in the past 6 months, which you can see highlighted down here. And you can see VIG is up 6.5%. Now let's go year to date so you can see. Definitely a difference here, basically a 1 point percentage difference. Over 1 year, DGRO is trailing by almost double. And that's because, remember, VIG is 23% weighted in those technology stocks, And that's why you're getting more growth right now. Let's look at the 5-year. As you can see, DGRO is trailing at 56% compared to 67% growth in VIG. Going to the 10-year chart, and that's what I like about these ETFs. We keep going back and back, but they have been around for a while. Let's go to the max and just see. Whereas DGRO, you can see this blue line right here. I'm going to zoom in to make it a little easier for you, just so you can see. So this is where DGRO, the blue line, has started in 2014, versus VIG has been around forever. So I like companies, or I should say ETFs, that have a long track history. So that definitely weighs in, where VIG has been around since 2006 and DGRO has been around since 2014. So they pretty much, over the whole lifetime, look at that percentage. It's like comparing apples to oranges at this point. You can see you have 242% for DGRO from inception, and then 250% from VIG. So there definitely is a slight difference, but overall, it seems like they're both really great funds. All right, so in the comments section, tell me what you think about DGRO and VIG. This is my channel, Trading Simplified, as you can see on the left side. And we've been starting to gain some traction with gaining viewership. So thank you for checking in. And I just noticed that, look at this first estimated revenue here, 53 cents. So we're making big bones here, being a new monetized channel. Thanks for tuning in. Like and subscribe. Really appreciate it.